As you know, a partner's proportionate share of partnership income and losses pass through the entity and are reported on the partner's tax return. Although income and gains are almost always recognized, there are limitations on the extent to which partners can recognize losses. If limitations apply, loss recognition is postponed until another event allows recognition. In this lesson, you will examine 3 different loss limitations that apply to partners in a partnership. After learning the concepts, you will apply them to Sunchase or Shakery. Most partners have a profit-seeking motive when they invest capital in a partnership. However, when operating losses happen, they can be used to offset other sources of taxable income. Unlike capital character losses, which are of limited usefulness if taxpayers do not also have capital gains to offset, ordinary operating losses from partnerships are deductible from taxable income. Therefore, before Congress is willing to allow partnership losses to reduce a partner's taxable income, the losses must clear 3 separate hurdles or limitations: basis limitation, at-risk limitation, and passive activity loss limitation. Let's examine each limitation in turn. First, the basis limitation provides that the amount of partnership losses a partner can use to offset other sources of income is limited to the partner's outside basis in the partnership. This limitation makes conceptual sense because outside basis reflects a partner's investment in a partnership. Consequently, partners are not permitted to recognize partnership losses in excess of their investment in the partnership, as it would be challenging to explain and account for on the tax return. Any losses allocated to a partner that cannot be recognized because they exceed the partner's outside basis are suspended and carried forward indefinitely until the partner has a sufficient amount of outside basis to recognize the losses. How does a partner obtain additional basis? If you think back to the lesson on basis adjustments, a partner can create additional outside basis by making capital contributions of cash or property, guaranteeing partnership debt, or by helping the partnership generate more profit. Note that any suspended losses remaining at the time a partner sells or disposes of an interest in a partnership are lost forever. Second, the at-risk limitation provides that losses that are deductible under the basis limitation are deductible only to the extent the partner is at risk for the partnership interest. Recall that partners allocated recourse debt have economic risk of loss, whereas partners allocated non-recourse debt do not, meaning the risk of loss on such debt is borne by the lenders. Therefore, the at-risk limitation, which is detailed in Section 465, limits the ability of partners to use non-recourse debt as a means of creating tax basis to recognize losses from the partnership to reduce taxable income. More specifically, losses that pass the basis limitation can only be deducted to the extent of the partner's at-risk amount, which is defined as outside basis excluding some but not all non-recourse debts. Specifically, the only non-recourse debts considered at risk are qualified non-recourse financing, which includes mortgages from commercial lenders that are unrelated to borrowers. As before, losses limited under the at-risk limitations are carried forward indefinitely until the partner generates additional at-risk amounts, or until they are applied to reduce any gain from selling the partnership interest. Finally, losses that surpass both the basis and at-risk limitations may be subject to the passive activity loss limitation, which provides that passive activity losses can only be deducted to the extent they offset passive activity income. Passive activity income is that which is from a trade or business activity that the partner does not materially participate on a regular, continuous, and substantial basis, or income from many rental activities. Material participation means that a partner has substantial involvement in the daily operations of the activity. By definition, a limited partner is considered not to materially participate in the management of a partnership. The ultimate purpose of the passive activity loss limitation is to reduce the ability of partners and rental real estate partnerships and other partnerships that they do not actively manage from using their ordinary losses from these activities to reduce other sources of taxable income. Taken together, partnership losses are deductible by a partner only to the extent that they surpass the basis, at-risk, and passive activity loss limitations.